Well, don't worry about Facebook or Google or any of those places tracking what you do, because the IRS is going to beat them all. We'll talk about that on this Sunday morning's program here on Dollars and Cents. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. Also, thought we might pose some of the questions that every retiree should be asking themselves now. Certainly, before we get to all of that, it's important to talk about the markets, right? Because where we are is not where we were at the beginning of the year. For many, many months on this program, if you're a regular listener, you know that we have been saying that folks need to prepare for a higher interest rate environment. For an environment where the tide does not simply raise all the boats as it relates to your equity portfolio. It sort of seems like perhaps the markets might have woken up to that this past week. Friday, worst day since, wait for it, 2020. Okay, so really not that long. Market typically does have bad days on a somewhat regular basis. But it seemed like the market woke up, smelled the coffee a little bit, and said, wait a minute, these guys at the Federal Reserve that keep talking about raising interest rates, okay, well, they seem to be serious. So, what did that do to the markets for the week? The Dow was down 2%, S&P 500 down about 3%, NASDAQ down about 4%. If you're keeping score since the beginning of the year, and I know many of you are, you'll find that the Dow is down about 7%, S&P 500 down about 10%, NASDAQ down about 18%. So, good opportunity, right, to recap what you should have been doing over the course of last year. That's, hopefully you don't consider it to be a shameless plug for our organization at Nelson Financial Planning, but these were the kinds of things that we were talking to our clients about on a regular basis. Okay, so enough of the shameless plug, but here you go. We got 5 things for folks to consider. And at the end of the day, it's really not too late, but you don't know that you want to wait much longer to sort of implement some of these action items, if you will. Number 1, during the course of last year, you should have been rebalancing. Talked a lot about that on the program. What does that mean? Well, it means you trim some profit. I mean, that's kind of what it is, right? You talk about rebalancing. When the markets perform one way or the other, it moves you off of your target investment allocation, right? So if 3 years ago or 5 years ago you said, I want my investment allocation 70% stocks, 75% stocks, 25% bonds, 30% bonds, whatever that mix was, and you did nothing, well, over the course of the past few years, you probably now have a portfolio that might be 85 or 90% stocks and 10% bonds. So you have a more aggressive portfolio than what you ever intended when you first set out on that journey, which means that you should have rebalanced. And ultimately, that's kind of what rebalancing does, right? It trims out the profit of what performed the best over the most recent period of time. It also recognizes the fact, and I hope you all didn't think that the markets were going to be able to generate double digit. I mean, you look at the trailing return on like the S&P 500, it's like 14%. I hope you didn't think that that was going to be sustainable for the rest of your life. I hope you didn't build your investment strategy, your retirement plan with the assumption that the markets would generate 14%, because that's not the case. And history tells us that is not the case. So hopefully, during the course of last year, you rebalance, you trim some profit. Not too late to do that. Probably want to be a little bit selective as where to do that, but certainly last year would have been a better time to do that than right this moment. Number two, you should have reduced growth, specifically your large growth, your large tech, and added in more large value, large dividend paying companies. Why? Well, you've heard us talk about this on the program before. The FANGs, right? Facebook, Amazon, Apple, Netflix, Google. Those were the companies that were driving the performance of the market over the course of the past few years. And the reality is, when you start to see that kind of level of concentration, 10 largest companies, predominantly tech companies, drove in excess of 30% of the performance of the S&P 500. 500 companies, you got 10 companies driving nearly a third of that performance over the course of the past several years, not just past year, but several years. Well, in our minds, that sounds a little bit like 1999. And it didn't turn out well for that particular sector once you moved forward from there. So you got to watch that. Certainly that concentration, that was one of the things that drove our recommendation to reduce down the large growth, increase the large value, particularly on this FANG stuff, that over concentration, very, very heavy relative to historical patterns. In fact, that concentration among those top 10 holdings in the S&P 500, more than what it was back in the late 90s. So an important distinction to know the difference between growth versus value. And speaking of those FANGs, big yikes, I guess, in stock market technical terms, because if you look at the components that make up that, what is that called? That would be called a abbreviation of that, whatever that is, that term, if you will, that you're looking at the F part of it, Facebook, since the beginning of the year, down 45%. The first A part of it, Amazon, down 13% since the beginning of the year. The A part, the other A part, Apple, down 9%. Okay, so that, that one actually is kind of hanging in the market. Netflix, the N part, well, we all know that had a bit of a disaster, down 64% since the beginning of the year. And then last but not least, Google, which is now known as Alphabet, down 17%. So stop and listen and process those numbers. Facebook down 45, Netflix down 64 since the beginning of the year. Pretty dramatic. And what happens is, when you start to see higher interest rates, the evaporation of cheap capital, those tech companies don't normally keep up as well as what they had been doing. If you want to throw in the other one that's generally considered in that category, toss in Microsoft as well. That's down 18% since the beginning of the year. Okay, so of those 1, 2, 3, 4, 5, 6 companies that make up the FANGs, wait a minute, 6, no, toss in Microsoft. So those companies, 5 of 6 of those are due to report their earnings. So we may very well be sitting here next week dissecting the market as well, given that 5 out of 6 are due to report earnings this week. It is earnings season. Last week, the only one that reported was Netflix. That certainly did not go very well. We're going to slide and take a break. When we come back, we're going to talk about the other 2 or 3 things that investors need to be doing, or should have done, during the course of last year. Perhaps not too late to do it if you haven't, but you need to get on it this week. With that, we will return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So on the program, we're talking about some of the things that you need to be perhaps thinking about if you haven't already done them. Probably should have done them last year if you were a regular listener to the program here on Dollars and Cents. These were some of the things that we were talking about at length for many, many months now. So we talked about the first 2, rebalance, rebalance, rebalance. I know we sounded like a broken record last year on that one. Number 2, reduce the growth, add to the value, particularly when you're talking about large tech companies. Boy, I'll tell you, the FANGs have really taken it in the shorts, if you will, so far this year. Going to be an interesting week ahead. 5 of those 6 companies, if we toss in Microsoft in that group, are going to be reporting earnings this week. The only one to do so far has been Netflix. That was last week. That didn't go so well for Netflix. That now down 64% since the beginning of the year. So just some considerations for folks to be thinking about. Number 3 on my list of action items that you probably should have done last year. Use short-term bonds or cash for the conservative side of things. If you're going long, you're probably not going to make that Hail Mary. The reality is, as interest rates have moved up, they've moved up very, very quickly. And so consequently, most bond funds, if you're looking at general bond funds, maybe even tax-free muni bond funds, down about 7 or 8% year to date. Well, that's kind of about the same as the Dow and the S&P 500 if you're watching that. So make sure you're using more, make sure you got the right type of bonds to the extent you're using that, and you should be, at least as part of your portfolio. Make sure you got the right stuff, if you will, in there. Number 4, make sure that you have about 3 to 5 years of your potential income or of your net worth sitting on the sidelines in that conservative side of things, between personal cash and the conservative mix in your investment allocation. So that overall picture, you should have enough on the conservative side of things to basically cover maybe 3 or 4 years of potential income. Now, if you're 5-10 years from retirement, I wouldn't necessarily do that. But if you are in retirement, then you certainly want to make sure that you've checked the box. Again, these are things that we were talking about at length during the course of last year. If you didn't do it, perhaps it's not too late to do it, but shoulda, coulda, woulda, right? Lastly, and this is probably the most important thing, assuming that you have done all of the kinds of things that we talk about on the program, and you did them during the course of last year when we were recommending that you do them, then just, buckle up, shut the TV off, and go on a cruise or something, right? I mean, just go on a cruise. Yeah, I get it. COVID's still around. Yeah, you know what? I think that one's going to be around with us for the rest of our lives. So, embrace. This is an expression. Well, no, I could probably say this. Embrace this. Nah, I'm going to skip this. It's a Sunday morning show. We're going to keep it clean. So embrace and you can fill in your negative imagery on that one. I dropped that one on a client a couple weeks ago, and they left the office shaking their heads. But the reality is that, hey, life's about living. So you better get out there and do it. Anyway, after all, why'd you save all the money? Right? I mean, why bother? And I guess if at the end of the day, if the world ends while you're away on your cruise, guess what? Doesn't matter. Doesn't matter. Anyway, with that, there's some thoughts in terms of the week that was and what you as an investor should, by now, have certainly been doing. But at the end of the day, not too late. Remember, some of these themes, okay? Rebalance, rebalance, rebalance. That's really what it comes down to. Make sure that the conservative side is, in fact, conservative and not getting too whipsawed as interest rates move up. I think a lot of people, when they see the performance of their bond funds, are going to be like, wait a minute, I didn't know that could happen that quickly on a bond fund, like for even a tax-free muni bond fund. Oh, but it can. And it does, and we've just seen it play out. So take a look at that. Make sure you have a pretty good understanding of what your mix is on the investment side of things. So anyway, this segment of the program, we don't have the wonderful Bud Hedinger introducing us. We kind of go in cold, so I have to take a few moments for a little station identification, program identification. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region, all the way over there on the Space Coast as well. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, so make sure you check us out there. Go to your favorite streaming social media platform, whatever that might be, and look for our channel. If you can't find us, sometimes you can't find us, go to our website, nelsonfinancialplanning.com, of course, right? .com at the end, and upper right-hand corner, bunch of icons. Click on the one that looks most familiar to you, and you will get immediately directed to our channel. Best way to know when we put stuff up, subscribe. Subscribe to us on your favorite platform, whether that's YouTube, whether that's iTunes, whether that's Amazon, whatever the case may be. Make sure that you subscribe to us so you know when we upload stuff, which we do each and every week to those channels. So, speaking of stuff, what a good segue. Speaking of stuff, do you sell stuff on Amazon? What about eBay? You know, stuff like the stuff that's in your garage, the stuff that's in your closet. Maybe you actually are much more handy and crafty than me and actually make something that somebody else might want to purchase. And maybe you do that through Etsy, right? I mean, there's all kinds of neat stuff on that website. Or maybe you do a little Airbnb, maybe a little VRBO. I've certainly done that with property that I own. At the end of the day, those are all great formats to sell a product or sell a service that ultimately generates money. And the reality is that what's changed dramatically for this year is now the IRS wants to know about your Etsy business or about your business, quote unquote, of cleaning out the stuff in your closet. This one's going to be a little tricky, and this is a big change for the year 2022. Much tighter tax reporting on income earned by people that are selling goods and services on these types of platforms. Now, this is new for the year 2022. If you earn above $600, it's a pretty low threshold, then the platform of which you are using, whereupon you earn that $600, is going to be sending you something known as a 1099K. That 1099K will give the gross amount of the earnings on that platform. You know what the rule was previously, just to show you how much this has changed. Previously, the generation of that tax form. Remember, when we talk generation of tax form, what happens? Well, our favorite uncle gets a copy of that. So you're going to have to deal with it on your tax return. Excuse me. So as you're dealing with it on your tax return, understand that last year you could make up to $20,000 and that's an important word in there, 200 transactions. So those are thresholds that were much higher that were in place last year until Congress changed it, did this incredibly low bar of just $600 in the stimulus bill. The stimulus bill that was supposed to be about COVID wound up generating perhaps some more problems for taxpayers. We'll talk about what those problems are when we return here on Dollars and Cents with Joel Garris of Nelson Financial Plan. Talking about the new rules that have the IRS tracking your activity on a host of platforms where you may be just simply selling some stuff, or maybe you're selling some arts and crafts, or maybe you're cleaning out the closet, but they are tracking you and they're going to make you report and tell them all about what it is that you're doing. See, you don't have to worry about Facebook or Google tracking you and knowing everything about you. The IRS is going to do that job just fine. The reality is this: it's almost ludicrous in terms of how much the thresholds have changed that are going to produce a 1099K for this year. Last year, the threshold's 20,000 and 200 transactions. This year, the threshold, $600. So imagine if you're doing anything on Amazon or eBay or VRBO or whatever the case may be. Now you've got a whole nother tax form that needs to be addressed on your tax return. That is a significant shift, right? So what it is is the reality is that there is an estimated, because nobody really knows what it is, tax gap of about 250 billion in this country, which means then that the IRS is saying, hey, it's about $250 billion out there that we should be collecting that we're not for a variety of reasons. About half of that is estimated to be involving income that doesn't show up on a 1099 or a W-2 or similar, right? Because remember, if you get a tax document from wherever, that tax document was automatically copied to the IRS. So they kind of really know everything. Understand the shift then that's happening for this year, courtesy of the COVID bill. How did the COVID bill mess with this? But it did. The reality is that now we've gone from 20,000 and 200 transactions to a $600 threshold. So think VRBO, right? So if you're doing something there, maybe you're rented the property for for a bit. Previously, you wouldn't have gotten the 1099. You would just roll that in on Schedule E as part of your rental property income. Now you are getting a 1099K, where you're going to have to address that. You should be able to just combine that into the Schedule E that you were doing, but again, it's another tax form that you got to pay attention to. And I guess the important thing is that previously that rule of 20,000 and 200 transactions, I mean, that kind of exempted a lot of stuff, right? I mean, let's say you make a surfboard bar. This is something I bought last year off of what was it, Etsy or whatever it was, and you sell it for $1,000. Well, you sell 20 or 30 of those a year. Okay, great, and fine. Previously, you wouldn't have to necessarily worry about that 1099. This year now, of course, you are, because even though you were over the threshold of the 20,000, you needed to have 200 transactions in order to trigger. So that combination of number of transactions and gross amount really sort of eliminated sort of the one-off types of transactions that you might do online when you're selling stuff, because then that creates that wouldn't have created a 1099 document. So reality is that folks have a major record keeping concern now for the year 2022. The good news is we're not that deep into 2022, so you want to make absolutely sure you're keeping track and taking some good records on it. Now, the reality is that if you're selling stuff out of your garage or your closet or something like that, I mean, how much you pay for it? You got a receipt? I mean, how are you going to keep track of all of that stuff? If you made something, right, how much did you spend on all those different components? Don't count your labor, because that doesn't count, right? Because the labor, that's not a deduction when it comes to when you make a good and sell it. You don't get to deduct your personal labor. You pay somebody else to do it, you get to deduct it, but you don't get to deduct your personal labor. So those are the kinds of excuse me, major considerations that you're going to have to be thinking about as it relates to how to deal with these 1099 requirements going forward. There is talk of changing the $600 threshold. That's actually that number, $600 threshold, based back in the 1950s, never adjusted for inflation. If it were, it would be around $6,000. Reality is that it's going to take an act of Congress, literally, to change this requirement. So you best start preparing now for what that looks like. Make sure you're trying to put those records together. Look for other formats, maybe craft fairs, Craigslist, because they're not a payment processor, particularly when you think about single ticket items, right? You sell a boat. If you sell a boat on eBay, well, that's going to clearly be above $600. Then you're going to have to deal with the reporting the sale of the boat, when at the end of the day, chances are, pretty sure if you're reselling the boat, it's a lot, well, maybe not right now because it's, kind of crazy out there in terms of used cars and used boats. But generally speaking, a boat is not something that goes up in value, or for that matter, a car. But if you use one of those platforms to sell it, well, then you've got to treat it as a business, even though that was a single transaction. So that's how deep this thing can go. So just be aware of that. Also be aware, if you do it, you best be on the lookout for that 1099, because if you're not, and you kind of file the taxes and sort of the boat that I sold, or the car that I sold on whatever the platform was, I didn't, there was nothing there to really report because I sold it at a loss. The reality is you better be on the lookout for the 1099, because if it gets generated and you don't put it on your tax return, well, guess what? You're going to get a love note from the IRS. So beware of that through the year 2022. Hopefully they'll fix this. I don't know. In fact, that's going to take an act of Congress to do so. Not sure that's going to happen. So just be aware. Could be that the return that this spells the return of the lawn sale. Won't that be fun? Won't that be exciting? Sitting around over the weekend, having people pick over your stuff. Anyway, so that's the latest on that. So we will shift gears now and continue the conversation about the headlines that were. And I thought it good, given the volatility that we're going through, what are some of the things that investors should be thinking about these days, right? I mean, the reality is that when you look at the broad-based market, S&P 500, you'll find that it's doubled in the past 3 years. That is giving folks a false sense of security on how this whole market thing works over time. Markets don't double within a 3-year period of time. That false sense of security could very well harm folks in terms of what, if their expectations are that kind of a return is going to happen going forward, or it could make them think that they have more money than perhaps they do, or they may think that they do. So some of the things that folks should be thinking about now, particularly in the current environment, really try not to have what's happened over the past few years cloud your judgment or your view of what the road ahead may look like. Markets had a great run. Markets had a great run. That's the important concept. Going forward, you have to think about, okay, well, what if this great one, what if the S&P 500 doesn't return 14% a year over the past 10 years like it has been? Well, then you've got some things to be thinking about. So we're going to give you some of those things that you should be thinking about, starting with perhaps it's time to adjust your expectation for the markets, and particularly adjust your expectation for inflation. Also had a pretty good period of time where inflation was really, really low, around 1%. So we didn't have to worry about that. Now we're going to have to worry about that. What can you do? You need to make sure that your withdrawal rate somewhere around 4 or 5% of the total, because if it's not, then you're going to be taking out a much higher withdrawal rate. And if the markets don't help correct that or cover that, then you're ultimately going to chew away at the underlying principle of your account. So make sure that your withdrawal rate is on that 4 or 5% range, so that if you do get markets that over the next 10 years maybe generate out only 5 or 6, then you are covered. So make sure you've got reasonable expectations as to what returns are going to be going forward. We're going to take a break. When we return here on Dollars and Cents, we're going to talk about some of the other things that investors and retirees should be thinking in today's environment. All that and more coming up next here on the program Dollars and Cents. Welcome back to the program. This, of course, is Dollars and Cents, Central Florida's longest running radio program, coming to you on a host of networks throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite platform of choice. Also subscribe to us so you know when we're uploading new things. We usually upload a couple of things every week on some of those platforms. So make sure you subscribe to us so you know where to find us. If you can't find our channel on those platforms, go to our website, nelsonfinancialplanning.com. and you'll see all of those different icons in the upper right-hand corner. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Talking a little bit about what investors, retirees, and pretty much everybody needs to be thinking about these days. We talked just prior to the segment about sort of the first thing that folks need to sort of grapple with, and that is the notion of curb your enthusiasm, or should I say curb your expectations. The notion that markets give you double-digit returns regularly over an extended period of time is not true. The reality is markets have a high level of volatility over time. Certainly the upward trend is there, but don't get too comfortable with what the return has been on the S&P 500 over the past 10 years of around 14%. That, folks, would be the definition of unsustainable. Also, inflation at 1%, probably not going to see that one too much going forward. So the issue is that if you are planning your future or planning your retirement based upon those two premises, 14% annual return, 1% inflation, ain't going to work. You need to make sure that you're using normal levels of return over an extended period of time. So for the markets, maybe that's 7, 8, if you want to push higher, 9. But in inflation, maybe 3, maybe 4%. I mean, you look at the historical numbers on this stuff and you'll see that it's not 14 and it's not 1. So be careful of that, because if you're using that, then you're creating yourself a false sense of security about how good a shape you're in for retirement. You've got to make sure that those expectations for inflation and the market are consistent with what they are, in fact, over a much longer period of time. I think far too often there's a psychological phenomenon called recency, which says that what's happened most recent is going to be what I think is going to happen going forward. That's not the case. I wouldn't bank on that one going forward, that's for sure. So make sure you've got reasonable expectations about market performance and inflation going forward. Make sure your withdrawal rate then is not at an excessively high level. If it is, then you run the risk of all of this going against you and you start to use way too much of your principal over time. Number two, and this is always a question anytime you have any market volatility, where folks say, is now a good time to get more conservative? Well, the reality is, as we've been talking about earlier in the program, probably should have done that last year if you were going to do it. Rebalance, right? Rebalance. That was a good activity to do last year. This year, a little bit harder to do that given some of the market volatility, combined with the fact that when you do that, sort of lock in those losses, and history tells us that that's not a particularly good thing to do, because the market moves quickly, both to the good and to the bad. So problem is, all you got to do is miss some of those good moves and you're going to be stuck with a much lower return over time. Combined with the fact that if inflation remains high, then you're going to be fighting a pretty tough crosswind, right? Because if you're getting too heavy on the bond side and interest rates go up, inflation goes up, ultimately you are not going to be able to ultimately stay up with both of those crosswinds. So best to be covered, obviously, with a portion on the conservative side, as we spoke about earlier in the program. Stay on the cash, stay on the short-term bond side of things. But as with anything in life, don't go too overboard. If you're thinking of, I've got a balanced portfolio that's 70% stocks, 30% bonds, and okay, fine, today I'm going to flip it to 30% stocks and 70% bonds. Yeah, that's not going to work. I mean, you're going to just really mess with your return over time. Remember, think about the current allocation that you have in your investments as something that's supposed to be able to weather things over the course of the rest of your lifetime. So maybe that's 10 years, 20 years, 30 years. That kind of perspective is important to maintain, particularly in today's world. Next up would be the notion of cash. Is that advisable to hold? Well, certainly it's better to hold that than a muni bond fund or a regular bond fund these days, because those are all down just as much as the overall market. But the reality is inflation bites. And when it's running at 8%, then that means that the dollar of it that you saved a year ago is only worth 92 cents today. So certainly important to have that, maybe have that in lieu of having an excess amount on the long-term bond side of things. But be careful with that, because it's not a great answer, particularly with inflation. Next, if we are in an inflationary environment, what types of companies does it make sense to own? And I think there the answer is you certainly want to have a cross-section, no question at all. Let's not get too concentrated in one sector or another. We've been talking a lot about in the program about how the large growth stuff really isn't working well. If you didn't have that over the past few years, you missed out on a lot of return. But you want to make sure you're balanced and not, sell all your large growth companies and say, forget it. But the reality is that you should also have an equal or healthy amount of dividend paying companies as well. So again, remember, it's about diversification. It's about balance. You don't want to be selling out one sector, buying into another. Again, that's a good way to get whipsawed. So be careful with that as you look at your kind of your overall mix. I talked about early in the program. Obviously, good time to rebalance. And remember your time horizon. And by that we mean you're not going to use all of the money in your portfolio in one shot. You're not going to use all of the money in your portfolio tomorrow. If you are, then you probably didn't save enough for your portfolio. The reality is, right, that you're going to use it over the course of the next 20, 30 years in retirement. So keep that perspective, keep that in mind when you think about what's going on in the market today. Today is important, yes, but the reality is that you should have a portfolio that's positioned to kind of weather things over the course of the rest of your lifetime, which is the time frame upon which you're going to need to use that money. Lastly, we get this question, should folks trim spending during volatile periods of time? And I think there's some pros and cons on that. I think that's fine. Maybe hold off on big ticket purchases, but I wouldn't necessarily look at changing the amount of my monthly income necessarily in response to that. If you can, fine, that would make sense to do that. But again, it goes back to making sure that your withdrawal rate relative to the amount that you've saved is at an appropriate level. If it is, then you should be able to continue that path and not necessarily worry about what's going on in any particular time during the course of the market. So bottom line, it's about the old essentials, isn't it? Diversification, rebalancing, staying consistent, all of that certainly good to keep in mind, particularly as the headlines are what they are. With that, we will wrap it on up and get on out of here. Thank you all for listening to the program here on Dollars and Cents. This has been Joel Garris of Nelson Financial Planning. Have a great rest of your Sunday. It looks like a beautiful one out there in Central Florida, so enjoy, and we'll talk to you next week.